So what do you want? You want to do storage? What do you want to do?
What
would you rather?
Whatever you guys want to talk about.
Okay.
I am an open book.
Yeah. Every 20 minutes long or so. So we'll talk about anything that long.
For sure.
I love just picking his brain. I love syndicating money.
Yeah, talk, like I think we talk
self-storage and syndicating.
Yeah. What you do, maybe your path to get on where you are, and then you talk a little bit about why self-storage is off. Then convert over to syndication of money, and
you guys work your way into.
We can do that. Absolutely. Cool.
Dude, I like the episode where I can just sit here and look pretty.
I mean, you're up here syndicating money anyway.
A little bit, yeah.
Working your way out of it.
And trying to get rid of some of it, and working on stuff. But
the secret is, instead of syndicating money, if you have one or two big private lenders,
yes,
where you could just buy it with debt, then refi it once it's stabilized, and you own 100%.
Private lending is better than that.
Yeah, it really. Debt over equity. Yes, absolutely. So that's one thing that might. Yeah, Perez, has a lot of success with.
Mm-hmm.
We need to find a few whales.
His friends
Well, he's got them locked. One does. We need to find some of my own. It's out there, man. It's out there. Those self-directed IRAs, they're out there.
So Dan up about just like, hey, and then they're out fishing.
Dude, that guy's I hope this makes a podcast. That guy's a bullshitter. Okay, that guy's a bullshitter. So he could bullshit anybody. But yeah, they'll sign their checks to him.
If they called us.
Yeah, that's true. That's true.
Pretty sure that was my entire career before you were there. Do you want to get us started?
What's this, number 6? Bar.
I think it's more than that.
Bar in the Investor Speakeasy. If this is your first one, we sit here, drink some bourbon. Try to bring different ones up a week. You probably see some people a lot. This week, we try to bring on some different guests, different backgrounds in real estate investing. This week, we got Paul Beets on, just moved down here to the Indy area. He's done a lot of single family, multifamily. Now he's the big self-storage guy. So we're going to delve into that a little bit. And we'll probably start off with, you're from Detroit originally, so you don't know. Or you were in Detroit before.
I was in
when
Detroit.
You started investing.
Grew up in Lafayette. Outside of Lafayette.
So some of your backstory about how you started investing and your background, how you got to the self-storage.
How did it all begin? What got you started here investing?
Okay, so living in Georgia, beautiful Peachtree City, Georgia. And I had a big engineering job down there, and got one kid. Wife is very pregnant with a second. Actually, I was in the delivery room. My wife was in labor with our second. I was in the corner, the delivery room, conference call with a Chrysler executive. They were in a stop ship of some vehicle that I don't remember, with some issue I don't remember, but I remember that was my son's. Yeah. And so after that conference call, I got the look from my wife. This is not the way she was promised. So at that time, I was like, something has to change. And I was a little disillusioned with my job. I'd been on the project for several years. I was like, I got to do something. So we started, General Motors had been courting me since I had left Detroit, because I lived a long life in Detroit in the automotive industry as an engineer. General Motors had been courting me for some time. And General Motors, great company, great work-life balance. I had traveled internationally for 5 years working for General Motors. And so when I moved to Detroit, we had decided need to figure out a way to have passive income so that maybe in the future we could, live our own lives and get away from the day to day. I'm fairly ambitious, workhorse. And so General Motors asked me to work 10, 20 hours. I will. That's how we got it started. And so I was one night, I don't know, my phone must have been listening to me because we were figuring out how can we get, find a different path. And I got hooked into home lines of credit. There's a company called Replace Your Mortgage, Replace Your University. And basically, you could pay your home off in 5 years using a home line of credit. And instead of paying my home off, I started investing in real estate. So bought my first property from Brian Snyder. Turns out Brian Snyder's first property that he had sold. But I financed it through my home. 5 years here coming in May, and started me on that path. What's nice is Replace Your Mortgage. I am a bit of a sales guy. So I had gotten some referrals to Replace Your Mortgage. And because I brought some referrals in Replace Your Mortgage, they had me come on as like a part-time sales. In the evenings, I would take phone calls, sell these memberships to this program. And these people that are looking for lines of credit to money elsewhere as well. So a lot of my private lenders came through contacts I had made through as a salesperson with Replace Your Mortgage. So bought a couple houses on my own. Was the grind, right? Put it on credit cards or the home equity line of credit, max it out or whatever, and realize, okay, let's see if we can figure out this private lending thing. And so I have a few private lenders, self-directed IRAs, down them administrator. They were nervous. I was nervous, but after the first of this time, what was this, like 2018, 2019, like looking back, is like, those weren't great days, but they were really great days, right? Because interest rates were very low. Housing stock was plentiful. I could buy a house, wholesalers for $27,000, rehab it for $60,000, they're appraised for $75,000 or $85,000. It was beautiful.
The good old days.
The good old days. So I did that quite a bit, and I probably bought more than I could afford, even with private lenders in 2019. I don't regret it at all, looking back, because during the pandemic, those homes doubled in value. So my portfolio, I'm only 50% leveraged on my portfolio because values just skyrocketed. So it was during the pandemic that my goal was 42 doors. And each door had to cash flow by 200 to 250 a month. So do the math. That's what I needed to retire when I started out. And I got to about 22, 24. I had a few duplexes that I've sold. And the pandemic hit. And this is like March, April timeframe. My wife did short-term rental management staging. And we were watching her business evaporate. Like short-term rentals, you get a lot of bookings in the summer, in March. People, especially after Christmas and New Year's, people start thinking about what am I going to do this summer. Right? March is like every day, ding, ding, cancellation. It was like Armageddon. So her business was drying up. And I was freaking out. Are my tenants going to pay their mortgage or their rent? Because they didn't really have to.
Yeah.
Right? I had mortgages on all of it because I had burning, refinanced them out of private money. Mm-hmm. And I had a few rehabs going at that time, wondering, are the banks even going to refinance me out of those? And so it was at that time that, I heard that whispering back, like, this is all of those naysayers that told me, if you get into real estate, you're going to lose your shirt. Don't you remember 2006, 2008? You're going to lose everything if you get into real estate. And I said, this is it. This is my 2008. I'm very, very fortunate, blessed to have invested in Indiana, where the courts were fair. I don't think that they were pro-landlord. I think they were fair. If you didn't try to pay your rent, you didn't try to make a deal, you weren't. If you negotiated, if you paid something, if you did something, you stay. And I had people that, they paid for months to get caught up. I was okay with that. I had some people I had to get a few, I'm pretty sure, professionals that moved in, and then even the courts gave them more time than I thought they should. So anyway, come 2020, it was November 2020, I'm down in Indianapolis for the Investor Symposium in November.
Mainstay.
Yes. Say shout out to Mainstay, and if you're listening, thank you for bringing me to Indy and opportunity to meet my partner, Margaret. He was in Indy with his wife Marie, looking to invest in real estate themselves. I met them at one of the events there, and it wasn't until later after that where he and I had he was looking at mobile homes, other asset classes. I was looking at how can we diversify out of the single families. I was looking at maybe apartment complexes because, if one is being evicted, the others pay, stuff like that. But at that time, everybody was in a multifamily. Everybody was. And it was super congested.
Rates were super.
Oh, it's insane. So finding a mom and pop, multifamily, good. But at that time, there was probably 60% to 70% of self-storage facilities were still owned by mom. And I met a nice lady. Her name's Stacy Rossetti. She is not super well-known nationally, but she's killing it. She's got 20 self-storage facilities, I think almost 2,000 doors. Runs a mastermind, and I joined her mastermind fall and started looking for self-storage. About that time, Mike and I chatted, why don't we just pair up? Because self-storage is a different beast. It's a big beast, and it takes a lot on the acquisition, on the financing. It's a whole different commercial financing is completely different. And then operating them, it's not a passive investment. Self-storage is not. Now, for my investors, for my syndication of investors, it's passive. There's a lot of work. It's a business that you're running. Absolutely. Yeah. And so needed a partner to come in and help. Mike was interested, and we got started. So it took us almost a year to close on our first one, but we had a really nice one, 250 units under contract in Davison, Michigan. And there was some title issues and cross collateralization were not disclosed. So anyway, wasted a lot of time on that, but got our first deal done, I think a year later. So it's November 2021.
So what was, so from when you started getting the storage to a year later, what was the reason that so long could have been done quicker? Was it just a learning process?
Well, it was definitely a learning process. So anytime I get into an asset class, you want to figure out how to underwrite it. Yeah. Underwriting self-storage completely different. Underwriting, single families. Finding them, right, is a challenge, right? I don't have a Randy I could call up and say, hey, what do you got in 46222, right? I had to figure out how can I find these, it's a different strategy to find them. And then even if I found them, what would I do with it? So I had to figure out how to operate them, right? Operate them efficiently.
Did you rely on your mastermind that you were in?
Absolutely. Everything that I don't know if I'd say everything that I know now, but a lot, probably 70 or 80% of my philosophy.
Every step of the way, you're like, okay, guys, now what?
Yeah, exactly. Yeah. But, we were ready to go. I think Mike and I signed on in February. We went under contract February of 20. Well, was it 22? It had to have been 22. I had to have been 22. We signed on to went under contract. It was either 21 or 22. And
what was it, 3 months after or a year after?
You went under. I went on. It was 20. It was in the fall of 20 that I went into the mastermind, and I'm pretty sure it was 21. We went under contract on our first deal.
That's amazing.
So 3 or 4 months, right? But that contract fell through. We dawdled, raising money and getting ready. And, we were ready to close. We had the money lined up. We were ready to close, and it just fell through. So then we had to start over. And Mike and I were really committed. We could buy one. We got to get going here. And I ended up finding our first deal up in LaPorte, Indiana. Virtually driving for storage. So you just pick Google Maps, turn it on to the satellite view, and you just scroll. And you're looking for a self-storage building. They're very, from the satellite view, it's either a chicken coop or it's, and chicken coops have like the aerators outside, the feeders outside. So I found this on Google. Skip traced it, just called him out of the blue. And he's like, yeah, we're getting ready to retire. He's moving to Texas. I'd love to get rid of this.
Do you mind? A couple clarifying questions there. One, for people who are familiar, what is skip tracing?
Okay, skip tracing is how you can find out who owns a property, or at least get a better lead on who owns the property. In this particular case, he had it in a trust. Word to the wise, if you name your trust, it's not very secure, because that's how I found it. It was, I don't remember what his name was, George Sanders Trust.
Yeah.
So you just skip trace George Sanders, then it gives up his email address, his phone numbers, all this. So luckily, it was his name, his wife's name, Trust. You need to come up with something, Speakeasy 123 Trust or something that's more, it would have been almost impossible, right?
Montana or something.
Yeah.
Right, yeah, exactly. So anyway, that's
what, okay, gotcha. So that makes a lot of sense. There's one other thing that I want to touch on that I think is important and a lot of people struggle with. But in today's society, there is so much information for free on. Why did you pay for essentially education and camaraderie when you could have gotten it potentially for free on the internet?
okay, for sure. So because I had already self-taught, I never took any real estate classes when I did single family stuff. I found, simple wholesaling through the internet. Just Google wholesalers in Indianapolis. I joined every single Facebook group I could find. I was on Bigger Pockets regularly. I'm listening. I know I'm going to be very popular, but Clayton Morris was, one of my, I know it's not very popular. I did the thing. But a lot of his underwriting that he taught on his podcast, that's what I used to underwrite my single families, right? All self-taught. I agree with you. But my thought process was, okay, number one, I think this asset class is larger and more complex than underwriting single families. Yeah. And I'm on a time crunch. Like I told my wife, we're going to move to Michigan and we're not going to stay here for more than 5 years. I'm pivoting away from what I self-taught and know into a different asset class that I don't know. I need to find facilities. I need to get them financed, and I need to figure out how to run them fast, and I need to grow my passive income faster because now I'm behind the eight ball.
I love that answer. And I wasn't trying to put you on the spot there.
Yeah, so
essentially what I'm hoping people hear from this is, yes, you could have gotten this information for free, most likely. But there were two things in particular that were important. One was speed. And second was you couldn't screw it up. Like on a single family home, they're expensive. Don't get me wrong. Not cheap by any means, but there was a little less risk there. We're talking about $100,000 purchase. Mm-hmm. When we're talking about self-storage, we're not talking about $100,000.
No, I bought my first property from Brian, $27,000. I remember standing in that property, and it's pardon my French, a shithole. And I brought my mom with me. And she's like, what did you buy? What did you buy?
They're going to be bankrupt.
Yeah, exactly. I mean, it was bad. I think my wife said,
oh, yeah.
Right. But instead of 27,000, now we're talking about 2.7 million, right? Yeah. And if I go to a lender, you almost have to have a heartbeat, especially at that time with interest rates. Yeah. They'll refinance that for you, right? If you got a heartbeat. 2.7 million, where's your business plan? You have to see
some credibility.
Yeah, I want to see some credibility. You have a history of doing self-storage. Do you know what you're doing? Yeah. Stuff like that. So you can learn that. You can fail and learn. I actually believe failure is one of the greatest teachers. But I didn't have the time to get, the school hard knocks.
Or the bank account.
Or the bank account. And I really, really believe this. I just bought into day trading, not to change subjects, but I want to learn day trading, and I don't have the time to teach myself. You can learn it from the internet. I really believe buying into education it pays dividends.
do something to ask questions.
Let's bounce ideas.
I'm trying to search and see if somebody's ever asked this question before.
Yeah.
It may not have.
And find
you
reputable
can just
sources.
send an email and say, hey, there's a situation. What would you do in this situation? Have you gone through this?
Yeah. Stacey Rossetti's course, not to give her a pitch, she deserves it. She does a great job, right? She'll teach you, soup to nuts. Joe off the street, I don't know, have any real estate knowledge. If you want to buy a self-storage, this is how you do it, all the way to the how to operate it and tips and tricks on how to operate it. She even has a facility owners mastermind where they focus. That's one of the downsides of some of these other things. Like, okay, now I've moved on from the beginnings. I'm operating 6 self-storage facilities. Like, I need to collaborate with other.
Level, yeah.
It's a next level, right? So I bought into the lifetime membership. And it pays dividends over and over. Really, it does. Oh,
Great.
So I probably diverted us there a little bit.
no, it's all good.
But do you, potentially, last question I've got on the education piece, I think that there's potentially value in people doing the same thing, even in smaller asset classes, like you're day
Absolutely.
trading in homes.
Yeah.
Space thing, wholesaling, all.
Absolutely. Absolutely. And especially flipping, and even like I learned a lot, School of Hard Knocks, on doing the build process, what to do and not to do. What types of countertops, what types of, we started putting the same LVP in every single place. Right? You'd have commonizing your bill of material. And that's one of the things I taught Mike when he first came to India is, you're going to go into, because I had a few vacant at that time. So I'm going to show you 3 of my properties. They're all going to look the same. They got the same canvas. They got the same LVP. They got the same agreeable gray. So and we've got cans of agreeable gray. We've got boxes of, I think it was washed oat Dove, and we just rinse and repeat, simplicity. Who teaches you that? Right? The internet's about, unless you're in these groups or asking these right questions. So
the system and process for.
Yeah, and learned. The first property I put a different LVP in, and then it cracked, and I ran it, and all we had was washed up Dove. What are you going to do? So, I think buying into masterminds and continuously learning and educating yourself, even if you've been successful already, it's well worth the money. Absolutely.
Fantastic.
So anyway, we went under contract. It fell through. It took some time to find the next property. I believe that we went under contract and closed in November of 21 on our first facility, very small facility. And, we made the mistake here where it had a small commercial space. It was rented by CSX. It still is. I mean, it had one building, like 36 units, but it was on 2 acres. And so when we did the underwriting on the numbers, we did the underwriting to say, we're going to build out, and the numbers don't work until we build it. That's a mistake. Now, any build out we do, it has to cash flow as it sits. And then the build out's the cherry on top. But that place we did build out, it's, 80% full. It's doing well, And so then I think it was in 22. We really, I think we bought 2 or 3 facilities in 22. And then we bought 2 more last year. So it makes 6. So it's been very good, to pivot into, when we first bought that first facility, we bought it for, I think it was $450,000. So we had 2 investors. We brought them together. They were friends. The bank, they did 80% LTV on the purchase and 80% LTV on the build out. It was like, like 3 3.75, 3.75 or 4. Oh, it was unbelievable. It's like Mike and I were laughing. Free money, right? And it was probably 6 months after that the interest rates started going nuts. But anyway, so it ended up being a very good deal. But as we went on, we got bigger and bigger. And one of the things we realized didn't come from Stacey, but you realize as you start to buy, is that instead of managing, 10 self-storage facilities that have, let's say, 20 units apiece, it's better to manage one self-storage that has 200 units.
Yeah.
Or,
greater economies of scale.
Absolutely. Absolutely. And so we just kept on getting bigger and bigger and bigger. And this last one we bought, I think we bought it for 3.7.
Wow.
Like 250 units. It's a huge commercial space to and so, small little one in Northern Indiana, it's almost a nuisance, right? Because it's so small, hardly get any calls on it. It's mostly full, right? So, from a build up or from a economies of scale perspective, we're doing our marketing, right? And marketing is a big piece of self-storage, and you have to be very, very good at it. All of our facilities pay a marketing fee into the company that we hire. Well, if you look at number of units, the ratio of how much the facility brings in versus how much they pay in marketing. As you get bigger and bigger, you're able to pay for some of these more important, fixed costs to operating efficiently. So that's where we're at now. Where we started syndicating as we got bigger and bigger. We established a fund.
So let's just take a second.
Yeah.
What the heck is syndicating?
Okay, syndication. We basically are offering equity to investors to come in and partner with us. So we're structured in a way that 70% of the equity is owned by investors and 30% is owned by Mike and myself. And sometimes we bring on some additional folks to raise money or whatever as general partners.
And again, doing this exercise for the here. I'm an investor. I have $1 million. I need you. Well, what's the pitch there?
Well, if you've got $1 million and you love to answer phone calls, man, go buy a self-storage facility. It's a great investment. But if you don't
want
like
a second job,
if you'd like to have a second
job,
you can get a couple second jobs with $1 million very easily. But if you want to invest and make a very nice return and reap the benefits from the tax perspective, you can invest that $1 million and yield 10 to 15%, and basically tax free for the first couple of years, right? So, and not have to never make a single phone call. So that's syndication, right? Our investors, our partners that have come in on these deals, they are equity owners. They own a piece of the self-storage facility. Now, when we formed a fund, now the fund owns multiple self-storage facilities. So it's even greater diversification where Muncie, Indiana and Memphis, Tennessee, you're invested partially into both facilities and those are both cash flowing. So one's doing well and one's they are feeding into your distributions, but you own a fractional amount of both of those facilities. So,
no, I think that makes a ton of sense. I was just trying to explain the value of being a passive investor. We all have our IRAs that are sitting there that we're passive investors and Apple, Google, all of their company, they get to do the same thing, but get the benefit of the growth and the cash flow.
Absolutely.
Break down even a little bit further and see how can people use their because a lot of people just don't have $1 million sitting around, right? Most of our money's probably in retirement. How can people use IRAs to invest for somebody else in real estate passive?
Well, the first step is you need to roll it into a self-directed IRA, either a Roth IRA or a traditional IRA. There's a couple administrators that I would recommend. If you're interested, reach out to me. But don't just go get your own administrator. I've got an investor right now. He picked an administrator that is very, very difficult to deal with. And, whole different story. But there are self-directed administrators where basically they give you checkbook control. So you can wire money into a self-storage investment fund, or you can wire the money to the racetrack and you can invest in resources. It gives you that level of control. There's rules about it where you can't put your your hands on your money because it triggers a taxable event. So you have to be very careful about that, which I think is why it's not as well known, right? You start messing around with that, people don't realize you could trigger a taxable event. But we help investors through all. So roll it over into self-directed IRA. Even a self-directed IRA, as I pay out distributions, I help my investors open up brokerage accounts, invest either in a money market or some kind of index so that their distributions are at least growing 5% consistently safely, so that when it comes time to invest in the next thing, right, their money has been growing a little bit. And you can do that in a self-directed IRA. And you have a lot more control over what it's invested in versus just handing it over Fidelity or Edward Jones or whatever, and then set it and forget it. And we are paying out, 10 to 12% in cash flow, pretty consistent. And, when you think about getting that in the market, right? I mean, I think the S&P averages 8% over the past couple of years or whatever. So, and you're going to pay tax on it. Especially if, I guess, depending on what IRA you're in, you may or may not pay tax on it. But you're going to get better returns for real estate type syndication than you might get unless you get loans. So we've got probably 50% of our investors have self-directed IRAs, and they're getting those distributions on a regular basis dropped right into their IRAs. And what's really powerful, if you have a Roth IRA, which is after tax money goes, but then you can invest in a syndication 10 to 15%. At the end, you don't pay any tax on those returns.
You already paid the tax
because you already paid the taxes. So that's. I don't know if you guys ever heard the guy that invested in PayPal. He had like a couple $100,000 in his Roth IRA, invested it all in PayPal at the very beginning, and now he's got a Roth IRA full of billions of dollars. And the government's like, "Well, we want some." It's all tax free. So,
seal, right?
it might be, yeah.
You got a seal. He's unpopular for other reasons.
No, for sure. But it's a good example of how Main Street can grow a tax-free account through real estate and have really strong returns. They can be tax-free returns. And then, of course, if you're investing not from an IRA, you just funds from your account, truly is tax-free wealth, or at least in 3 years, depreciation. It's very strong returns for.
Yeah, absolutely. Well, I know there are a lot of people at different stages of their investing career. Some of them may just be starting. Some of them may be a little bit further down the path, where they're starting to think about syndicating. They think about raising debt themselves. Do you have any advice for people that are looking to start doing within their own network, their own portfolio?
Yeah, I mean, I think what I was always told when talking about raising capital, either debt or, private lending, or for capital partners and a syndication, it's kind of like a donut. And it's really your sphere of influence. So you start with friends and family, and your family will get tired of this, but it is what it is. In every family outing, every family event, every family reunion, you're talking about what you're doing in real estate. And you don't necessarily have to say, "Hey, Randy, you got any money I can borrow?" It can be, "Hey, Randy, some investors, I just did distributions. We paid 10%.
Yeah.
And Randy's like, "Oh, wow. I made 3% of the market. Well, if you're interested, let me know." So that's how the conversation starts. This is what I'm doing. And that's why we're right here on this podcast. This is what we're doing. This is what we're going out doing, and being successful. So then once you get past your friends and family group, it kind of goes out to another, extended group. And that's a little bit harder. Networking at different events, going to real estate meetups, joining podcasts, stuff like that. And then, once it gets out to the far end, you have to start thinking about, SEC compliance and advertising and stuff like that. I've had a lot of success. It's like you need to be where the investors are at. So, like I said earlier, I worked for a company that, they sold a product to a group of people who were looking to refinance their home, were looking to pay their homes a lot more quickly. And oh, by the way, they've got some cash to do it with. And oh, by the way, they're looking get a better return than the market. How can we help you do this? And so I was very, very fortunate to have access to a lot of people. Some of them became clients, some of them didn't, some of them became permanent loaners, some of them didn't. But, it was really, again, just talking about what am I doing? It's not a, hey, do you have any money that you'd like to invest? It's, this is what I have going on. This is what I do. These are the returns that we're seeing, talking about what you're up to, what you're out. I think the more you do that, the more you talk about what you're doing in the right groups, in the right places where these people, that's where you end up with, lenders coming in. I don't know what the statistic is, but there's like $1 billion or more of retirement funds that are not even invested. They're sitting in cash in self-directed IRAs or Roth IRAs. People don't even know what to do. And it's all out there. It's ready for you to come in and help give a better return than sitting.
That's such a smart approach that you said there. And sorry to cut you off. What you said there, that most people don't understand in sales. Most people think should be coming to you. Hey, this can give you. Where the difference is, what you're saying here is talk about what you're doing and what you're doing for others, and then let them come to you. It changes the power dynamic.
Absolutely. And, I really see it as a partnership. I'm not out begging for, I don't need the money. I couldn't do the deals without that money, but I don't need it. I'm here to help you. And by helping you, you're going to be helping me. And so it's a win-win scenario. I always am looking for win-win scenario. And oftentimes I've ran into situations where whatever they got going on, it's not a good fit for me, right? I can't give you what you need. Like I had a guy come to me, he said, I need to retire in 3 years. Look, we're going to hold these self-storage facilities for 7 years. That's 5 years and you retire. It's illiquid. It's an illiquid investment. Now you'll get distributions, but can you live off those distributions? Probably
more long-term.
It's more long-term, right? So, it's great for those 30, 40, maybe 50-year-olds there. If you're 65 and getting ready to retire, right, exactly, right. It's probably not a good thing, right? So, everybody has their own goals, their own situations. And I'm always looking for a win-win. And we really present it as that.
To go on top of, there are regulations on how to actually advertise some of the stuff to people. How you can't. So can you go into that a little bit further? You can't basically go on Facebook and go like, hey, this is we get it for private investors. Here's your return.
Yeah, he's not a lawyer. You're a lawyer.
Or a lawyer, new CPA, nothing.
Correct. Yeah. So number one, anytime that you syndicate where you trade equity for an investment, by definition, that is a security, right? And any security attorney will tell you, encourage anybody that's thinking about doing a syndication or maybe even investing in a syndication to consult an attorney, because I'm not one, but bizarre. There's 2 exclusions, right? One of them is, I think it's a 506C. The other one is what they call the good deal exclusion, which is it was such a good deal that nobody complained. And so even though it may have not been legal, it worked for everybody and nobody complained. I never liked the good deal exclusion. Right? That's a little scary to me. Right. So, Mike and I decided early on, we're not going to take the chances on the good deal exclusion. So our fund that we established was a 506B. And what that meant was we could take both unaccredited and accredited investors. Now, what does that mean? Well, that's a little nebulous as well, right? So accredited investors, I think you have to have such a net worth, you have to make so much money, and over like such a period of time. And a little bit of it is, like a self-certification. I think you can get an official certification from a CPA, consult your attorney on that. But we wanted to be able to raise from both accredited and non-accredited. So non-accredited is like anybody Joe up the street. If they say that they got money, they got $25. Right, exactly. So the 506B allows them, I think we were limited to 30 uncredited. I think we only raised 40 total. So some of them were accredited. But as a 506B, because it can go to non-accredited, we were not allowed to do any advertising whatsoever for any reason. So we had to be very, very careful. And there's some steps that you have to go through where was like the 5-touch rule, where your acquaintances, how do you establish that you're an acquaintance, that you haven't found them on Facebook or whatever. And, we had to be very careful with our offering memorandums, what language is in there, what were, the disclosures and stuff. We worked with SEC attorneys to establish all of that information, and any material that we distributed to anybody came through our SEC attorneys.
This is why you talk.
Absolutely. Right. Exactly. So, 506C though is only accredited investors. So anybody that is willing to say that I'm an accreditor, or they can get their CPA to say that they're an accredited investor, you can advertise on Facebook. And I think there's still restrictions on, the SEC attorneys still want to approve your advertising posts and your advertisements. So those are the different securities types. I don't know. We're getting ready to form another fund. We're really on the fence about whether we're going to do a B, which allows us to bring more accredited, or we're going to do a C, which gives us more flexibility on advertising. I'm probably going to do a C because, again, we're our donut, right? Our inner group, which a lot of those inner group are not accredited. Even we've tapped it. You've gone out to that group where we really, our immediate network and even our immediate or our network just beyond that, we've really tapped that. So we're to the point where we're outer donut, and we've got to start raising money from a larger audience. And so that's talking to more accredited investors. That's probably some.
All right. Well, before we hop off here, I'd love for you to talk. You talked a little bit about the equity side of things. You talk a little bit about the debt side, how it compares.
Yeah, absolutely. So before we got started, we talked about, you can invest in real estate or get financed in real estate through private lenders, 2 different ways, right? You can offer debt, and you can offer, and the equity side is the syndication and ventures and stuff. So most of my BRRRR deals were debt. And so basically my private lenders, they've got self-directed IRAs, and let's say they've got 150,000 in their self-directed IRA. I'm going to go to Randy, and he's got a house in 46222, and he's selling for. So this is what I did. I'm not going to encourage people to do this because I think you got to know what you're doing. But I would borrow the full 150 out of the self-directed IRA. I would buy that from, and they'd drop that 150. They just wire it from the self-directed IRA into the title company. The title company, I would always use their attorneys, would draw up a promissory note and more. And so, like, if I was hit by a tractor or disappeared to the Caymans, they still had an interest, a financial interest in the property. They could foreclose on me just like a bank could, and they could take that property. Now, none of my private lenders ever want a property, but it is just a level of security, especially some of my private lenders that just take. I know you're going to do what you need to do with it, and I trust you, but especially starting out with private lenders, if you're doing debt deals, having that promissory note mortgage, that mortgage in the hand is like, this house is mine. If this guy doesn't do the right thing, this house is mine. And that gives a lot of confidence to private lenders. And I insisted I never did any, even though they said this was not necessary, I never did. Because I just think there's
I really want to shout that out. It's huge. Huge. I mean,
yes.
if somebody's throwing money at you and they're not even asking for a promise, like that's a free.
Don't skip that.
Don't skip that. It's something that we do internally, I'm sure, on all of our deals. Brooks has done a couple with private money lenders. I do them all the time. Like, yes,
I insist on it. Absolutely. And, it's not, at some point, it's not even for them anymore. It's for me, because I know I've got to play by the rules.
Yeah. Bigger than that.
That's right. I'm not bigger than the rules. And so I always insisted, that's what it was like $300, $400 for the attorney to draw it up.
Right.
Whatever. And it's a little bit of a hassle when you do a refinance if they don't do the lien release. But, at the end of the day, I always want to do it right by my investors. And if something happened to me and whoever was going to take over after I'm gone, I wanted them to have an interest in the property.
Not only that, like if I have a heart attack here tomorrow, it's not on my
Exactly.
the family doesn't have to worry about it. It's where it's going.
Exactly.
Not going back to the investor.
So anyway, they would wire the 150 in. We buy it for 90 plus a few closing costs, right? And then the title company would wire me the proceeds. So that's another key thing. When I was selling the property or to private lenders, and I was talking to private lenders, it always ran through the title company. And I always told people, don't ever take money from a private lender directly, right? Never, ever, ever. It always goes.
That money.
It always goes through a title.
Why? Why?
Well, there's a lot of different reasons, but number one, when you're like on Facebook, right? These people are, I'm a private lender, blah blah blah. Send me $500 or $1,000, and that's a pre-financing deal, and this and that. There's a lot of those out there, right? And they don't want to deal with title companies, right? I never ever paid points or financing fees anywhere else other than through a title, right? Don't ever, ever, ever pay a lender for anything. I've even gotten after, there's been some banks that asked me to pay for the appraisal up front before I got to the settlement statement. And I said, hell no, put it on the settlement statement. Go ask your Aunt Richie or whatever to pay for the appraisal. I will pay it through the settlement. So any fees exchanged with a lender of any kind should go through a title company, should be on the statement. Otherwise, you're getting scammed. Truly, you're getting scammed. Do not ever do that.
They're getting so darn good.
They're getting very good at it. Actually, my mom was just telling me with some family members that I got talked out of some money. It's really, really bad right now. So anyway, and that makes our job harder because if you're approaching somebody that has some money and they're wanting to get the 10%. By the way, that's another thing. I would always pay 1 point. Like that is, and some people would say, well, they'll give it to you with a point. Yeah, but
What's the point?
a point. So if I borrow 100,000, I'm going to pay them 1,000 in back to them. So it's kind of almost like a financing fee. It's a lender fee. It's a thanks for doing business fee, right? And so I would do 10% interest only back in the day of 4% interest rates.
Right.
That was a great deal, 10%. Now, I almost feel guilty doing those because I feel like I ought to give them 12 and 2 or something. But I did all of my deals were 10% interest only. It was on a balloon, so 12 months balloon. My goal was to be out of it by 6 to 9 months. And I always paid them a point. And I just think that's good business. Right?
Yeah.
And so, you do the math on it. They're getting 11 and some change. But here's the other thing, like they're going to drop that money back into their self-directed IRA checking account that's non-interest bearing. And then it's going to sit for maybe a month or two before Randy comes up with another deal for me.
It's a win-win. Like you're not trying to ever get one up on somebody.
Absolutely not.
It's a win-win.
It's exactly. So again, that's just something that I always did. And I could have saved thousands of dollars by negotiating at one point. But the truth was, like, look at what I have, my portfolio I own, personally. That's one of the benefits of debt is if you find a lender, even if I could find one for self-storage, let's find a self-storage that's $1 million. I've got a lender that will loan me $1 million on debt. So I don't need to go to a. Then I'm going to pay a point, which I don't know, what would that be? Would that be 10,000? Yeah, it'd be 10,000. Anyway, then when I go to stabilize the self-storage after a couple of years and refinance it with a lender, now I own that self-storage facility. Me and my wife, nobody's involved. And that's the benefit of, doing a debt deal versus a syndication. Not that I love my partners, I love my capital partners. I love paying dividends to them and seeing their retirement, accounts grow and them sharing in the tax benefits. But there is some nice benefits to owning a property just you, right? So
that's putting into all.
absolutely. So anyway, I'm buying this 90,000 deal from Randy. They wire the 50 in. So I take the 60 and I use Profit First. I don't know if you guys Profit First, really amazing system. If you're any kind of business, transformed how we do our self-storage stuff. But I have an OPM, other people's money account. I take that 60,000 up. So any income that comes in, any principal interest, they're separate accounts. That OPM, and I only use OPM for that property for that rehab. And I never really got to that point where I had like multiple rehabs going all at once. Thank goodness. If I did, I would have had OPM 1, OPM 2, or OPM, Alabama, or OPM Union, or whatever. Yeah, to keep them. Well, Alabama is just because I had a Union on there, Beets Hendricks. I'm familiar with some of those streets down there. But anyway, I would have that separate. These are the lenders, and this is their money. And when I go to refinance this, if it doesn't appraise, that money has to come out of this account and give it back to the private lender. Right?
I love that approach.
So just being a good steward of other people's money, I think that benefited from it, right? So you do the right thing, begets future success.
So before we wrap up here, I'd love for you to help me the way that we form some more.
I'm going to talk faster.
If we're to rank the money, and I'm interpreting it, it's would you place in like the order in which you personally?
I would invest. If I could get a bank to finance a place 100%. I think I'll probably get some haters for this, but I would take financing first.
Dave Ramsey.
I know, Dave. Dave, if you're listening, I'm sorry. I don't have any.
Kidding me? Dave, you know what, Dave? I don't really like.
But the thing about it is, right? I'm going to pay my private lenders more than I would pay.
Yeah.
Right. I'm going to pay them 10 or 12%. A bank, even today's rate, I think you said you were at 7. Okay. 7's better than 12, right?
Sure.
So, banks aren't going to do 100% deals. Maybe never. So, it would be bank financing, and then it would probably be debt, which would be like debt private lenders.
Yeah, all right.
Or I would even call it like seller financing would be in the same bucket, right? Seller financing or private lending debt. That would be the next one that I could refinance back into bank debt later. And so then the next one would probably be my own personal. I will tell you, there is a school of thought there, and I'm in my old age, I'm starting to get to the point where my mother-in-law, she bought several properties free and clear. And I told her at the time, I said, they're not going to cash flow like, they'll cash flow very nicely, but the return on investment isn't highest. Well, I didn't realize we were in a pandemic and rents were going to go through the roof. And so now she's getting like 12% on her investment because rents went through the roof and she bought them for very good prices. And so now she owns these free and clear. All she does is taxes and insurance and then repairs. Like she's cash flowing on 2 or 3 properties more than cash flowing 20 properties.
I mean, that's what insurance companies call an act of God.
Oh, I agree.
I've got the fact that leverage. She's got the biggest item in everybody's P&L that we're talking about in most real estate is the mortgage.
Or what it came from the act of God.
It is.
Yeah,
it
fair,
did.
fair,
Yeah.
yes.
So, like, I'm happy for it's
Good for her.
Good for her.
Great. Yeah, and it's one of those things where It's what do they say? It's better be lucky than good.
Every time. So,
but I think I've done very well. On the same token, I have mortgages on most of my properties, but I'm over leveraged 50% because the values have gone through the roof and the cash flow has improved. So, I would prefer to have 20 properties instead of 3. I think leveraging that's allowed me to do long term, the amount of equity that I have in those properties when I sell them in another 10, 15, 20 years, you might will be far, far and away anything that she made in flow. But the cash flow right now is nice. So
she's optimizing for us. Each individual investor needs to just, if you're buying cash, you're buying for cash flow today. If you're buying in debt today, then you're probably buying for cash flow and ROI in the future. When you're investing with OPM, when you're doing an equity play, then you're probably investing for the greater future, the longer term situation. Be fair?
yeah, absolutely. And one of the reasons why I started using private lenders and then we eventually went into the syndication equity deals is because I wanted to scale and I wanted more cash flow faster. And so I'm willing to do a lot of the legwork. I'm willing to do a lot of the sweat equity. And I'm willing to do that on a large scale. And the only way that you can really do that, you can't do that necessarily with it, right? Unless you've got a really, really large investors, finance wise, that can find, like I said, they can write a check for $3.2 million. If you've got a debt, it'd be awesome. It's tough. So you got to go bank financing. I couldn't at least self-storage facilities. I'm probably one of them in my entire lifetime, and now 6. And so I think there's a long-term appreciation there that will benefit me and investors. And I think a lot of wealth building over time and leveraging bank finance. Is that what you expected?
Totally.
Yeah.
I think that was a really good.
Exactly.
People want to get in touch with you either to invest, to learn from you. What's the best way we get in touch with you?
So you can email me, Paul, Paul, biggergarage.com. Bigger garage, as in your significant other has way too much stuff in the garage. Put your car in there. Biggergarage.com.
Go in Carwell and I'll be ready to go.
Absolutely. Absolutely. Well, hopefully one of these days. I don't know.
So we'll really appreciate you hopping on.
Yeah, thanks a lot, Paul. It's awesome.
That was great. There was a lot of nuggets there. Brooks at brbuysindie.com.
Randy at brbuysindie.com if you need a property or any Indianapolis market information.
You need your help with big head off leash investment. I'm here to help.
Cheers, guys.
Cheers. Great episode.